But imagine you buy here. You buy that. Now tell me where you might place your stop loss. Where would you place your stop loss? If you were buying that breakout, maybe underneath this little low here, maybe you're going underneath there, or maybe you're going underneath that low there. Tell me what bar knocked you out. What bar got you? Was it that one? And what's that bar? Are you seeing it? You starting to see it? So here's a question for you. Would you like to be better able to identify institution accumulation when you look at a stock chart? That's what we're going to cover in this video. I'm going to teach you two main types of candlesticks to be looking out for to better identify that institutions are in there accumulating the stock. So it's not just the candlesticks, but it's the location of where you see it in developing bases and in relation to key moving averages. So the two types of candlesticks I'm going to be teaching you about are variations of what I call shakeout demand tails. These are hammer candlesticks, doji dragonflies and takuri lines, and then the second type of candlestick is what I call a gap down reversal bar. This is variations of piercing patterns, belt hold bullish, meeting lines bullish, frosting, and also bullish engulfing candlesticks. To do this, I'm going to show you two main charts. We're going to look at the Dow Jones weekly chart from the 1920s, as you can see right now, and you will see a lot of gap down reversal bars, and you'll see a lot of shakeout demand tails that occur across all time frames. You'll just see these things across all time frames, from the minute chart to the weekly chart to the monthly chart. And then secondly, we're going to pull up a chart of AMD, but the charts are going to be 27 years apart. So I can explain to you these shakeout demand tails, gap down reversal bars are timeless. Market operators, certainly large market operators, accumulating positions is timeless. And hopefully you'll also understand what is really going on from a supply and demand perspective when you see these gap down reversal bars and you see these shakeout demand tails. Market Surge are today's video sponsor. Market Surge is the platform that I use to look at the fundamentals of the stock when I'm looking for a stock that has true market leader characteristics, big earnings, big sales, big estimates, impressive relative strength. If you're interested in a discounted trial, then there is a link in the description and the comment section below. Okay guys, we're going to start off with the Dow Jones weekly chart, and we're back in the 1920s. So we're going to go high level here so I can just give you a feel for, okay, what do gap down reversal bars look like? What do shakeout demand tails look like? Then when we go into the AMD chart, we're going to look at the daily time frame. The two charts are going to be 27 years apart. That's where we're really going to go into the weeds, and I want to explain what is actually happening from a supply and demand perspective when you see a shakeout demand tail, when you see a gap down reversal bar, but also thinking about it in the context of the developing base as well. And do you see things happen around the lows of bases, around key moving averages? So that's where we're going to go very deep. Here we're just going to do a high level overview so you start to dial in the pattern recognition. So a gap down reversal bar. The key is looking for a gap down, as the name implies, followed by a reversal. You got it, gap down, reversal bar. So if we take a look at this one here, say in the middle of the chart, okay, what actually happens? Well, we can see the index here in 1926 is like a waterfall, okay, it's just going down week after week after week basically. So the prior weekly close is here. Now what happens with this gap down reverse bar? It gaps down, as the name implies, opens near the low of the week, and then has a strong reversal bar closing very near the high of that weekly bar. So this is just a subtlety here as we start to think about strength of the bars that we're seeing. Again, when I say relative, it's important that we're comparing things, apples and apples, oranges and oranges. So we're not comparing the chart of the Dow Jones and thinking what is a widespread candlestick, what is a wide shakeout demand tail relative to, say, Union Pacific at the time or Bethlehem Steel at the time. Okay, we're not doing that. We're keeping the analysis focused on whatever financial instrument it is that we're looking at. So if we're looking at Apple, we're just comparing the behavior of Apple to Apple. If we're looking at AMD or Nvidia, we're comparing it to that specific stock, okay? So with the Dow Jones here, it gaps down, opens on the low of the week, and then reverses and pushes up. So this is a good thing to see with a gap down reversal bar, is the open is near the low of the overall candlestick, of the real body, and also the range, so the low to the high, and then it pushes up, and the stronger it can close, so the closer it can close to the high of the bar, a better indication of strength. If you think about that from a supply supply and demand perspective, that's quite logical. So if we look at this one here as well, the prior close is here, it gaps down, opens here, there's a little shakeout demand tail that you're going to be learning about, and then it closes on the high of the week. So it gaps down, opens near the low of the bar, and then closes on the high of the week. So with these gap down reversal bars, you're looking for them to gap down, open near the low of the bar, and then close very close to the high of the bar as a better indication of strength. If we talk about shakeout demand tails, we can talk about this one here, and we'll also just bring in kind of thinking about large operators as well. So it isn't retail traders that create the lows of bases, okay? It wasn't retail traders creating the lows in 1926 and 1927, and it's not retail traders creating the lows in the SPYs, in the Qs, in the AMDs, in the Nvidias, of the Ubers, in the metals of the world, okay, in 2024. They're not the ones doing it, it's institutions. And there's two things that institutions require above everything else. Number one is liquidity, and number two is perceived value. Why do I say perceived value? Because value is in the eye of the beholder. What you perceive as valuable, institutions may not. What institutions may perceive as valuable, other institutions may not. Other retail traders may not. Okay, so it's always perceived value. But institutions, what they're really looking for is liquidity and perceived value. If you think about Warren Buffett's quote, who is a large operator in the market, no doubt about that, his quote about be fearful when others are greedy and greedy when others are fearful sums up the mentality of large operators. Okay, so when others are fearful and panicking, that is oftentimes where institutions, the really large operators, go, thank you very much for the liquidity and the perceived value. We're going to step up and start buying and start accumulating here. So around the lows of the bases is just an area that Bayesian mentality, the base develops, you update your decision-making process, you look and you go, okay, what am I seeing here? Well, this is kind of like a VCP ascending triangle, right? You have one contraction, higher low, two contraction, three contraction with a higher low, four contraction with a higher low, price volatility, tightening from left to right, another sign that there is accumulation, there's absorption, the structural higher lows, also bullish. But what do you notice is marking the lows? Gap down reversal bars, shakeout demand tails, shakeout demand tail, two gap down reversal bars, shakeout demand tails. Interesting. So with shakeout demand tails as well, they can be very useful things to see, because if you think about a shakeout demand tail, so if I was to draw this shakeout demand tail that I've just circled a couple of times, okay, price basically opens here, goes down, and then comes back up and closes here. So what is this? This is saying that, okay, supply came to market and drove prices down, which can sometimes be large operators, just letting price fall, undercut some recent lows, take out a load of stops. So certainly if it's around kind of undercutting recent lows in a base, maybe it undercuts like the 21-day EMA or something like that. So this is why when we talk about AMD, it's the location of where do things happen. So, okay, great, you identify a gap down reverse bar or shakeout demand tail, but where does it happen in the context of the chart? And what is the relative strength? So we're going to talk about that with AMD. And then buying comes back in. So this is then a signal of demand, of buying. So if you think about what we're seeing with gap down reversal bars, it's price gaps down, opens near the low of the bar, pushes up, strong close, demand. If you think about a shakeout demand tail, okay, the open is here, price goes down, there's then buying, and then the close is up here. And again, this could be on a 1 minute chart, a 1 hour chart, a daily chart, a weekly chart. For me, I'm an intermediate term trend follower, I'm a swing trader. I spend the vast majority of my time looking at daily and 1 hour charts and also the weekly chart. So this is where I'm then looking for these type of candlesticks to form around the lows of bases, potentially in applicable index ETFs, group ETFs, theme ETFs, the indexes as well, the Qs, the SPYs, and kind of those group ETFs will be like SMH, semiconductor ETF, IGV, software ETF, GDX for the gold miners, things like that. Okay, so what we're going to do now is now you've got a little bit of a feel for gap down reversal bars and shakeout demand tails. You can see them on the weekly chart here for the Dow Jones back in the 1920s. We're going to now look at AMD side by side, 27 years apart. So we've got the charts of AMD loaded. On the left hand side, the chart is from December 1992, and on the right hand side, the chart is from December 2019. So these charts are 27 years apart. Both of them are on the daily time frame, and both are in the context of continuation basis when the stock is in an uptrend and showing relative strength. So for me, I'm a swing trader, I'm an intermediate term trend follower, and what I'm trying to do is position myself in the leading stocks of the day, whatever they may be, as they are building continuation type bases. So that's commonly going to represent a flag, a Darvis box, a pennant, a wedge, a channel, a VCP, ascending triangle, cup and handle, all of that good stuff. So what we can see with AMD in both cases is it's building a continuation type base. So as I was talking about on the Dow Jones weekly chart, okay, it's great that you see a shakeout demand tail or a gap down reversal bar, but where do you see it? What's the context? What's happening? So there's a couple of things that we're looking for. For me, certainly, I'm looking for the stock to be in the context of an uptrend, respecting certain moving averages. So the black line is the 10-day EMA, the blue line is the 21-day EMA, and the purple line is the 50-day simple period moving average. I'd like to see the stock trending above those and displaying relative strength. So relative strength, I've got a free tool, search my name on TradingView, you'll find it. It's this one here, okay? You can stick it to the bottom of your charts like this. So what I'm looking for, 2019 is a better example where AMD, the relative strength line is up like this, and it's up heading into the base, and ideally there's these blue dots. What are these blue dots? These blue dots are relative strength 52-week highs versus the S&P 500. So the better large operators and the more savvy ones will be trying to generate alpha so they can get more assets under management. So invariably you'll find that they are trying to go to the stocks displaying relative strength that are outperforming the index, which is usually their benchmark. So when I see the likes of AMD, so your kind of true market leader, William O'Neill, Can Slim criteria type stock that are displaying a lot of relative strength hitting 52-week highs, big earnings, big sales, big estimates, global products, and they're hitting 52-week highs, continuation type bases forming, and then I start to see, wow, okay, shakeout demand tail, gap down reverse bar around key moving averages, undercutting lows. And I'm going to get really interested. So let's stay on gap down reversal bars to begin with. So there's two that I'm going to talk about. I'm actually going to zoom into this one here, okay, this first one, because this is a really nice continuation type base. So when you think about a gap down reversal bar, so we're going to be looking at this one here specifically, okay? Maybe we just highlight this in a blue so you know which one I'm talking about. So if you think about this gap down reversal bar, leading stocks, this is my belief, leading stocks are trying to go higher with the fewest market participants on board. Okay, large operators, they're all savvy ones. They are doing everything they possibly can to knock you out of your position. So when you understand how the game is played and you understand what the institutions are trying to do to shake weak hands out of their position, you can start to realize their tactics. Now their tactics for me take the visual form of, you got it, gap down reversal bars and shakeout demand tails. So when I see these bars in developing bases, I see it as a really constructive sign. Certainly if it's a leading stock in the market, from both a technical perspective, preferably a fundamental perspective as well. Big earnings, big sales, big estimates, global product, new technology, so on and so forth, right? So the key with a gap down reversal bar is you'd ideally like to see stock in a powerful uptrend displaying relative strength. Then you've got to have a little bit of imagination for how bases may build out. But if we just talk about this gap down reversal bar here, for instance, okay, so the stock is pulling back down. There's actually a bit of a shakeout demand tail here. But you see this gap down reversal bar, okay? It gaps down, opens pretty much on the low of the bar, pushes up, and closes strong. And would you say that's a wide range relative candlestick? I would. If you look at it relative to the prior 20 sessions or so, to me it's probably the widest real body. It's probably a bit wider than that, probably a bit wider than that. So it's a wide relative real body. Now why is that important for us? Well, it gaps down, opens near the low, pushes up, and closes strong. Are you seeing the demand here? Are you seeing it? Okay, think about it. Price gap down, the prior close was here, so it gaps down to here, and then does this. Turns around, just like that. A lot of buying, strong close. Now this is where we start going into the nuances of this as well, because okay, it's a gap down reversal bar, but now we want to think about the context of where we're seeing it, and we're going to bring the volume into it as well, okay? So leading stocks will invariably find supportive action. Some will be the 10-day EMA, but for a lot of them, I'm talking the AMDs, the Nvidias, the Ubers of the world, kind of your bigger market cap ones, right? Your Metas as well. Okay, when they're showing a lot of relative strength, I think the real sweet spot is the 21-day EMA. Okay, institutions, yeah, they can step up around the 10, but I'm also going to be looking around 21-day EMAs, potentially 50 days as well. So really the blue line and the purple line is where I'm really going to be interested in stocks like AMDs, the Nvidias of the world for these type of bars, okay? So if you think about it, price gaps down, opens here, pushes up, strong close. Is this retail traders doing this? If you think about the amount of shares traded, which is circa 55 million on a $38 stock, it ain't retail traders doing it. If I just show you in terms of the dollar volume, let me show you, okay? So let's pull this up here. Let's say it's about 52 million shares traded. Sorry about the clicking. And let's just do an average price on that bar, $38, okay? The dollar volume on that day is $1.9 billion. Nearly $2 billion worth of stock is traded. So when you think about it in that context, okay, what are we seeing here? What do we have? We have nearly $2 billion worth of stock exchange hands. And what happens? What's the result? That's interesting. Well, it's a gap down reverse bar, opens near the low, pushes up, closes strong. If institutions, we think they're active here, they must be because of the dollar volume, right? Does it look like they're distributing? Does it look like it? Or does it look like they've just gone liquidity, perceived value on a short-term basis, we're stepping up. And now we start going into the weeds a little bit more, okay? Think about where the low of that bar is, okay? If I was to just draw this across here, the low of that bar undercuts the last 2 or 3 weeks worth of trading. So imagine if you're a trader and maybe you're buying it in here, maybe you're buying it in here, maybe you're buying it in here. Where are you going to place your stop loss? So here, maybe another sell rule. Common sell rule is when it goes below the 21-day EMA, that's an exit. Well, imagine how many weekends just got shaken out right there. Now this is the crux, okay? This is the key of the video. Gap down reverse bars and shakeout demand tails are designed to shake out weekends. So when you see them, it can also be a constructive sign to go, institutions are in there accumulating positions. They're shaking out weak hands, they're supporting the stock. Now, I'm not going to go into kind of targeting trades and things like that in this video. I just want to keep it dialed in. This over here would be on this shakeout demand tail. Very, very, very good setup. When you think about the initial risk involved, shakeout demand tail following the gap down reverse bar, like 1.4, 1.5% initial stop. That's going to be a very favorable setup. That's a very, very good setup. I'll speak about this in the blueprint video and 50 videos, 100 other videos on the channel. Okay, let's just keep it focused on gap down reverse bars, shakeout demand tails. So these are very constructive signs, I think, to see that, okay, institutions are in there, they're up to their usual game, potentially accumulating positions. Really, really, really like to see it. Now, if we can see AMD is doing this, Nvidia is doing this, and 10 other semiconductor stocks are doing this all on this session, could be quite interesting. I'd give that even kind of greater weight in terms of that weight of evidence. So the more stocks in the group that I see displaying this behavior, gap down, shakeouts, then tightening up, nice continuation type basis, the greater weight that I'd give it that this is like a group wide move. Institutions in there up to their usual games. So if we now just, this is the chart here, right? But if we just pull this across, so then we can just focus on this chart. We'll talk a little bit more about shakeout demand tails. So what do you notice is marking the lows of this base, right? If I was to draw this base, say from here, like this, in this blue zone here, okay, you also have, well, let's actually do both of them, right? Because this is, again, it's like, it's the crux of it, right? The institutions create the lows of bases. So let's just make this one over here orange or something like that, right? So we have our orange base and we have our blue base over here. What do you notice is marking the lows of the bases? Remember what I said earlier, institutions, liquidity, perceived value. 2 things they require above everything else. Reference points that we're looking for these things, 10-day EMA, 21-day EMA, 50-day SMA. 10-day EMA for a lot of stocks, unless they're really quick, a lot of leadership, are going to be too quick. But potentially bases can set up this kind of like a nice flag, Davis box type pattern build here, okay, in this orange zone. But what do you see marks the low? What do you see? What do your eyes see? Shakeout demand tail, shakeout demand tail, gap down reversal bar. Now, I target a lot of these setups if I think the risk makes sense, if I think it's favorable risk versus reward. I look back at, okay, if the stock is going to break out from a base like this, what is kind of the probable return? When if I look at the last 3 breakouts, 5 breakouts, 10 breakouts, how far may this stock go or may it not go? And then I think about that in terms of the initial risk that I'm then taking on the stock, but it won't go too far down that rabbit hole. But if we start looking over here, and we'll talk about these shakeout demand tails, look at this shakeout demand tail on a lot of volume. Okay, this is designed to shake out weak hands. Think about it. The prior close is here. What happens? Price gaps down, opens here, goes down during the session, and then there is buying into the close. So again, it's a signal of demand. And imagine how many weak hands. Imagine if you were in this in December in 1992. Okay, maybe you had bought this breakout here. Imagine you bought this breakout, right? If you're watching this channel, you're probably a trader, right? Maybe you're a breakout trader. Imagine your entry is here. Now, hopefully this is going to bring the chart to life, okay? Because this is just psychology. And this is understanding different market operators are trying to do different things. You want to have awareness of yourself. You want to have awareness of other market operators. Imagine you bought this breakout, okay? You bought this breakout. Tell me where you're going to place your stop loss. Where are you going to put it? I'm going to take a guess. I'm going to hazard a guess. I'm going to say here, right where this red line is. You ready? I'm going to say right there. Would you place your stop there? Would you? Maybe you put it a little bit lower. Maybe you went here. Or you're still shaking out. Maybe you put it down here. Don't worry. you're still shaking out. See what I'm trying to say? This is the crux of it. Most of you guys, okay, you're going to use pretty good risk control. I'm going to imagine you're a pretty good trader, right? If you're watching these kind of videos in depth and you're kind of 25 minutes in or however long we're in, right? You probably place your stop here. It's okay. Maybe you're kind of giving it a little bit of room. Maybe you sold some until this little pop here. You're trying to sit. Yeah, it's pulling back down. Shake out demand tail. Sure, a YouTube video on that. That's constructive behavior. Maybe you even place your stop loss in here. Maybe you moved your stop up. Oh, they got you. Liquidity, perceived value. You see the games. You see what's happening. So this is what I said earlier on in the video. It's not just what's happening. It's not just, oh, tickety boo, you saw a shakeout demand tail, a gap down reverse bar. Where did you see it? And what do you deduce from that large operators are doing? Now, because the volume is very high on this bar, what is that telling us? The volume is telling us there's a lot of activity. Think about volume as activity. Think of it as effort. There's a lot of activity. There must be. It's the largest volume bar in a long time, and it's the largest volume bar that we can then see on the chart. So guess how many stop losses were probably hit? Guess how many weak hands saw that? Because remember, this is then the Bayesian mentality. This shakeout demand tail did not look like that mid-session. It looked horrendous if you were long this stock. It's on the lows down here, and it looks like it's going to come crashing through the 50-day. But it didn't by the close. And this is that Bayesian mentality that you develop as you become a trader. You constantly update your decision-making process as new information becomes available. Now, what starts happening? Well, what do we then see in this blue zone? We have a higher low. Higher lows are bullish. And what marks the low? Another shakeout demand tail. Just before I forget as well, by the way, you see this gap down reversal bar that we're talking about here? What do you notice about the volume? The black line is the 30-bar average. What do you notice about the volume? It's below the 30-bar average. How much activity, how much selling was there in this zone? Not that much, not on a relative basis. So this is where if you see a shakeout demand tail or a gap down reversal bar undercutting a key moving average, undercutting the last week, 2 weeks, 3 weeks, 4 weeks of price action, and the volume's not very high on a relative basis, that can be a very constructive sign to say, hey, there ain't that much activity, there's not much selling at these levels. That can be a really good sign, okay? It can also be a good sign as well if you see a high volume, because that's just saying, yeah, load of stop losses, load of weak hands, taken out. Like it. Weak hands, out they go. Institutions, in they come. We like that, okay? Then you get this higher low, shakeout demand tail. Then look at the strength here. Look at the buying. This is what I call bullish synchronicity. Price gaps up, opens on the low of the bar, and pushes up. What does this signal? Same as the gap down reverse bar. If the gap down reverse bar gaps down and opens on the low of the bar and pushes up. So if it opens on the low and pushes up immediately and the open is the low of the day, what does it tell you about how immediate the buying was? How immediate the demand was? It was immediate. The stock gap down, open on the low of the day, buy orders, hit the market immediately, able to overpower sell orders. It's a really, really good sign. Same with these gap ups as well. Okay, gaps after this high-low shakeout demand tail off the 50, pop in the volume as well, bullish synchronicity. There's a synchronicity between the widespread candlestick and what in terms of the volume and the widespread candlestick. So the volume is confirming the positive price action. Bullish synchronicity, right? And then what happens? Well, we then pull back down. Look, so imagine this up here. Imagine you're a breakout trader. Here we go again, all right? Imagine you're a breakout trader. Okay, and you look at this and you go, all right, I see it. I see it, it's tightening up. Yeah, look at this, it's tightening up, okay. A little high, low, it's popped here. Oh, look at this inside bar. It's putting an inside bar there. The volume's dried up. Maybe you're forgetting this is very V-shaped in nature right now. But imagine you buy here. You buy that. Now tell me where you might place your stop loss. Where would you place your stop loss? If you were buying that breakout, maybe underneath this little low here. Maybe you're going underneath there. Or maybe you're going underneath that low there. Tell me what bar knocked you out. What bar got you? Was it that one? And what's that bar? Are you seeing it? You're starting to see it. It's a gap down reversal bar. And where do you notice the open of that bar is? So price gaps down, opens on, you got it. The lower the bar, pushes up, strong close. There is an immediate presence of demand. So think about how many stop losses and how many weak hands were panicking right on the open. Stop losses being triggered, weak hands panicking, oh god, this thing's gapping down, percentage wise it's gapping down, that's a big gap down, it's about 7% gap. Okay, breakout traders who are buying this up here, they're going to panic. But think about that. There was enough demand by large operators to take out all of the stop losses and all of the panicky sellers earlier on, absorb that supply and push up. The open is to lower the bar. There is an immediate presence of institutional demand on that bar. So this is where you want to be aware of the games. You want to start learning the games. Okay, you want to look at a chart, bring it to life. Bring the psychology to life. Realize different market operators are doing different things. And you want to try and buy with the institutions, not against them. So I love to see the really strong stocks in the market that are basing, and then they put in these shakeout demand tails, these gap down reverse bars around the lows, around key moving averages. Okay, for me, when I'm then looking at it like this here, when it then tightens up, because then you have to ask yourself, okay, if I'm targeting that, stop through the high, targeting it through the high, stop underneath the low. I mean, 4.25% is not bad if you're swing trading off the daily chart, but then 2 bars later, it then tightens up, the volume dries way up on this shakeout demand tail that just says, sweet FA in terms of the supply, and 2 bars ago we just shook out a load of weekends. Okay, now potentially we've got a really favourable risk versus reward trade. Now we're talking about 1.4, 1.5%. Okay, now that's pretty asymmetric in nature. So then it starts tightening in there. So this is what I wanted to do with this video. Make you realise that large operators, they're the ones that really control where prices go. And ideally you want them to be on your side. Okay, you want to see what side they're on, and then you want to be on that side. You don't want to be on the other side. Okay, you want to be on the side with large operators. You want to start seeing these things. Okay, yeah, shakeout demand tails, gap down reverse bars. Okay, it's happening there. Where's that happening in relation to the base, in relation to the moving averages? What am I seeing the brother sister stocks do? Am I seeing a shakeout demand tail, gap down reverse bar after a recent breakout that's potentially knocking out those breakout traders? Then it resets. So I know, just to conclude, many of you would have read Davis's book, How He Made $2 Million in the Stock Market. Now, about 20 years later, he wrote another book, and he significantly changed his rule. Now, do you know what he did? With his Davis boxes, he wouldn't buy the first breakout. Let me bring this to life for you, okay? So I'm sure many of you have read the book, right? So it's a classic, right? So if you think about this, Davis and his Davis box, okay? What Davis would have done is Davis would have bought this breakout. He would have gone, okay, it's a stop in a base. I don't know if he would have bought this breakout exactly, but hopefully you understand the point that I'm making, right? But I'm going to tell you the main change that he made. So Davis would not buy in his second edition, okay, where he updated his rules significantly, okay? Think about that, the humility to change, to evolve, to get better, to improve. Love that about Davis. So what Davis did is, what he found was he was buying the first breakout out of his, what he deemed a Davis box. And what he found is he was getting shaken out a lot. And guess what? He didn't like it. So then what he did is he went, I'm not going to buy the first breakout because breakout fake outs. I'm going to buy the second one. There you go. See this? See the psychology? Bunch of breakout traders come in here. They will get shaken out here. They will then give up, and then stock does that. So that's it, guys. I'm going to wrap that video up there for you. Hopefully it was enlightening. Hopefully it kind of brings the charts to life a little bit for you. Okay, when you're then analyzing a stock and you're going, yeah, okay, check out demand tails, gap down reverse bars. What am I seeing? What are different market operators doing at different points on the chart? If you like this stuff, you may like some of the stuff we do over on my platform. Thank you very much for watching the video. Thank you very much for all the support on the channel. Really do appreciate it. Hope you have a fantastic rest of your day, rest of your week, wherever you're watching this in the world. Thank you for watching, and I'll see you in the next video.